Welcome to Capital Link's company presentation series.
Welcome to Capital Link's company presentation webinar series. In this series, senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. I am Nicholas Bornollis, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we're privileged to have with us the senior management of International Seaways. We have with us Ms. Lois Zabrocky, CEO, Mr. Jeff Pribor, CFO, and Mr. Tom Trovato, Investor Relations Manager. The whole session will be 45 minutes. We will start with a brief slide presentation followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of your screen, or please email them to us at webinars@capitallink.com and we will forward them to the speakers. Again, thank you very much for joining us, and I am going to turn the floor over to Ms. Lois Zabrocky.
Thank you so much, Nicholas. It's really a pleasure to be here with you today and to be invited to speak with yourself and all of your listeners. International Seaways, we start 2022 with a lot of expectation in anticipation for a market recovery in our tanker sector. International Seaways, we went through a large merger in 2021, and we'll get into the details of that. And we have 84 tanker vessels. We are both in crude and the product markets. These markets are very linked. And as we see the tanker market recovery on the horizon, the product carriers are an early bellwether of the markets to come as you see refinery margins start to pick up and demand levels ever increasing. At International Seaways, our market cap is presently around $700 million, and we are a leader in environmental, social, and government's forefront. When you look at our fleet on the lower left-hand side, we're very evenly balanced between crude and products. We have 39 vessels that are trading in the crude markets. We have 30 of what we consider to be the bigger ships, 13 VLCCs, 13 Suezmaxes, 4 Aframaxes, and 9 Panamaxes and LR1s that are trading in our niche trade in our joint venture with Ultragas of Chile and Flopec of Ecuador. And then we have 44 vessels that are MRs and Handysize. So we're well represented on both the crude and product sectors. If you look into the middle column, you see our joint venture. We have 50% of 2 FSOs that have been on station off Qatar since 2010. These vessels have had 0 off-hire time and bring in cash to Seaways between $10 and $12 million per year. Once we've completed the payoff of the existing debt in September of this year, this joint venture will have 0 debt and will produce $20 to $21 million of EBITDA, so cash flow coming through directly to International Seaways. We do continue to look at exploration and monetization of the FSOs, which we would affect if we find the right valuating partner, and it's something that we've been looking at. Then if you look at lightering right below the FSOs, this is a very high touch business that is headquartered down in Houston, very service intensive, and the lightering has brought in between 4 and 4.5 million in EBITDA over each of the last several years. This is an area where our team, and I'll talk about it a little bit in our ESG, our team took extreme efforts to make sure that we protected all of our mooring masters as they went out on the lightering workboats to service all of the lightering in 2020 and in 2021. And then if you look on the right-hand side, what you can see is with an 84 strong tanker fleet, we have a lot of leverage to the upside and to the tanker market recovery. Every $5,000 per day brings in 150 million in incremental cash flows to international Seaways. So we are well poised to take advantage of what we believe will be an upturn in the markets as demand continues to rise and tanker balance comes into play. We're going to see this market really come into its own. Next slide, please, Tom. In this chart, you can see a bit of the international Seaways journey. We've been independent for 5 years. And as we went out on our own, we have been very active. You can see in 2017, as well as in 2020, we extended our FSO charters, first for 5 years, then for an additional 10 years. When you look at the joint venture on the FSOs, that 15 years secured over $1 billion in revenue for the joint venture. Then you see that we sold our fixed rate LNG project for $123 million in the second half of 2019. When we did this, we immediately went to work improving our balance sheet and significantly lowering our cost of debt. And then all the way to the right, you see that this year we did a major integration merger with Diamond S, and our integration efforts have proven to be a success. And this is something that we'll talk about more as we go through 2022, and we share the, both revenue enhancements as well as the cost reductions that we've been able to parlay into international Seaways. If we pop to the next page, this is really very busy sheet, but it's packed with all of the concrete initiative that at International Seaways we've been executing significantly during the downturn. When the tanker markets are weak, it's incumbent upon us to act counter-cyclically so that we're well positioned like a tight coil when the markets recover to take advantage of that. So just a couple of things I want to call out on this page. When we completed the merger with Diamond S, we continued our regular 6 cents per dividend each quarter. This was the first dividend that Diamond S shareholders had received from them going public. We've returned $95 million to shareholders in 2020 and 2021. Those are very powerful when you look at the fact that over the last 15 months, the tanker markets have been exceedingly weak, and we've been returning cash to shareholders as well as buying back shares. During the downturn, we purchased nearly $900 million worth of vessels at the cyclical lows, which again is absolutely critical in the tanker markets to find success. At no point have we issued any equity. We consider ourselves an industry leader in ESG. We put out an ESG report in December of 2020, and we have one that will be coming within the next few weeks, reflecting all of our efforts in 2021. Best in class commercially and technically. Just going to call out one of the points on this slide. We are a founding member of Tankers International, which was incorporated over 20 years ago. And in this leading VLCC pool in the world, now our customers are being offered the option to buy carbon offsets so that they could have a carbon neutral voyage. So the pools that we participate in, each one of these pools is not only optimizing revenue, but is also taking initiatives to make sure that they're keeping up with all of the latest expectations in the ESG in the world today. The next point, we talk about attractive leverage. And when we get to the balance sheet, Jeff will dig into this more. But we have under 46% net loan to asset value. You know, operating the company in this manner allowed for International Seaways to be able to respond very quickly, to work together with Shell and build the 3 VLCCs that we are building in Daewoo. So when we, you know, if you run your balance sheet where you have enough strength to be able to take advantage of these opportunistic chances that are coming at us and then really build on something and implement it strategically into the fleet, it's absolutely critical for the future of International Seaways. Next slide, please. So what you really see on this slide, if I can call to your attention, you see the hills and the valleys in the tanker cycle. On the left-hand side, you'll see that we acquired 7 VLCCs and 2 Suezmaxes during the cyclical downturn of 2017. Then, if you shift over to the downturn that we've been in the midst of in the tanker markets, you'll see that we locked down building our 3 dual fuel VLCCs at Daewoo when they were $96.5 million. And we completed the merger with Diamond S during the downturn. So these are the absolutely critical initiatives that we've been taking at International Seaways while the market is in its nadir. We know that we are in a cyclical market, and we know that demand has been recovering behind the scenes. So we know that our tanker market will break out. And I think what's really important is for investors to be with a company that will be robust enough to take them through the downturn and then be well positioned to take it and capitalize on the upturn. If you can go to the next page, Jeff, I'll turn it over to Jeff Pribor, our CFO. If you could just share a little bit of our capital allocation and how we've been returning cash to shareholders, even in these less than robust tanker markets.
Thank you, Lois. As we all know, the capital allocation decisions that a company like ours has to make range from acquiring assets, which is, as Lois has run through, we have done in significant amounts at the right times in the cycle without issuing equity, deleveraging, and we'll get to the balance sheet a little later, and we'll show how we've maintained low leverage. And then it's about returning cash to shareholders. And this slide encapsulates the 2-year track record we've built. Now, I focus on 2 years because while we have been around for a little longer than that, the first few years of being an independent company, we had a legacy balance sheet that wasn't as shareholder friendly to the possibility of returning cash to shareholders. But once Lois and the team had renewed the fleet, by the beginning of 2020, we were able to put in a new capital structure, which allows us much more flexibility for appropriate capital allocation through the cycle. So really looking at the last 2 years or 8 quarters, this is what you see on this page. We've been able to return $95 million in cash to shareholders by way of dividend, regular quarterly dividend, which we initiated in Q1 of 2020 at 6 cents a quarter, share repurchase, or special dividend. So in 2020, it added up to about $37 million. And in 2021, close to $60 million of a mix of these various methods of returning cash to shareholders. So you'll find that that's about 6 to 7% return to shareholders relative to our sort of average market cap in each year. It's a little larger market cap in 2021 because of the merger. So we're quite proud of that track record of being able to maintain a consistent return to shareholders, even in a really tough markets like last year, and we expect to do so going forward. Lois, back to you.
All right, thanks a lot, Jeff. So if we look at our ESG footprint, we really have multiple buckets. There's a lot of emphasis on the environmental component, both internally at International Seaways and externally in the world today. So, we look at our existing fleet, and each time we're putting a fleet into dry dock, we are now optimizing that vessel. We're either putting on slick paint, Navis ducts. We're constantly looking for all of the seemingly incremental tweaks that you can make, as well as day-to-day optimization. We work with software company Trace. We've been doing that for a number of years, and each of the sister vessels is put up on a grid, and it's either red, yellow, or green, and we are looking for the optimal performance. All of the vessels have very competent, high-level professionals on board. And once you give all of your officers the tools, you see these ships really optimized. From a social component, International Seaways, we have 30% women on our board. Our first priority is always safety at sea and safety ashore. We are 86% vaccinated now with our mariners. And this is a 3,000 strong mariner pool. And it is really an achievement that we're proud of, because the United States has been wonderful in all of the ports, working with a lot of volunteer organizations, Seamen's Church, Seafarers International, coming down and making sure our guys can get vaccinated. We have programs ashore for vaccination. So this has been a full frontal effort at Seaways and all of our partners to get our seafarers vaccinated. And then when you look at the governance side, one of the things we're very proud of on our governance is this has been a priority for us and our predecessor company over the decades, I think long before people were actually paying attention to it. And we have no conflicts of interest, no related party dealings. And we score very high in the top tier consistently of Michael Weber's scorecard. So this is a component that's embedded in the culture of International Seaways. And then if we look at our commercial pools and our technical operation, people will say to us, oh, at International Seaways, you are actually outsourced. Yes, we're outsourced. However, the majority of our team, including myself, used to run commercial pools. So we have a group in our commercial team led by Derek Salone, who is overseeing the performance of our commercial pools and sitting at the table and assisting in driving strategy. We take great pride in working together with the pools to make sure that our earnings are optimized. And on the technical front, we have a dozen in-house technical folks that are working together with the technical managers to make sure that our ships are being operated safely, efficiently, and looking for how do we improve going forward in all of our systems. Then I'll turn it over to Jeff for the balance sheet.
Thanks again, Lois. So this is a snapshot of our September 30th balance sheet, but it also provides for reference, looks back to Q2. And Q2 balance sheet was the last one for International Seaways before the effect of merging with Diamond S, and Q3 was therefore the first balance sheet that reflects the combination. So a couple of things to note. If you look at the line on the asset side for vessels, you can see that we nearly doubled, thank you, Tom, the size of the assets to $2 billion. And then over on the right side, the equity line from just under $1 billion to $1.245 billion, reflecting the accounting effects of the stock for stock merger, which was the way that we acquired, again, about over $1 billion of vessels coming into Seaways at the right time in the cycle. But yet, if you look at the bottom left, we've been able to maintain moderate, or I'd say low leverage. Net debt to total capitalization, you'll see, is under 44%. And on a market basis, we look at net loan to asset value, including all of our vessels and our FSO joint venture, it's just over 45%. That's where we target, is to be under 50% net loan to value generally. And we feel very proud that we were able to do as much in terms of adding assets through the merger and the 3 dual fuel vessels and still maintain that low leverage. Since on the bottom right, since the merger close and Q3 close, we have had some significant additional liquidity enhancing items, such as the refinancing of 6 of our VLCCs. This is attractive financing in its own right, but it also has put us in a position where, in Q4, the total liquidity of the company exceeded $250 million, closer to 300, after the completion of that refinancing between cash and undrawn revolver. So a very strong balance sheet and liquidity position. Lois, back to you, I think.
Yeah, I think that if we take a look at this slide, what you clearly can see is that we have a very cyclical tanker market. In 2020, the market went, as everyone likes to say about gas prices this winter, parabolic for a moment. And the reason that we've been in our downturn has been that we are wearing off the inventories that were built up during that uptick. And at present, inventory levels, particularly in OECD, which we believe are also reflective worldwide, basically the levels are back down to pre-pandemic levels, and even levels that are reflecting lower demand periods, such as 2010 to 2014. So this is a market that has now had demand growing, inventories drawing. We're still backwardated, so inventories are still drawing. However, when the market turns and inventories need to be built, you can see the tightness in the market, and it's somewhat reflected in our $88 Brent pricing that you're seeing in the world market today. So I think with that, we'll take a pause and go towards any questions if there are any. Tom?
Yes, Lois, we have a few questions here. The first one that is listed here is, if supply is constrained by lack of investment in oil, is the tanker market in a structural decline? We know OPEC has spare capacity and has limited spare capacity, and other countries with spare capacity are not included in production.
Yeah, so, responding to that question, if we look at the United States, just for example, only 12 months ago, the predictions were that the United States was in a structural decline. Now, the predictions are for the United States to increase 1 million barrels per day of production in 2022. So, we still have in the world significant new finds. Guyana, Petrobras is coming on strong off Brazil. You still have significant quantities. If there's a deal that's agreed with Iran, that's another well over 1 million barrels a day, if not 2, coming online. So there's significant resources in the world of oil supply that can come online, as and of course OPEC and Saudi still have some additional reserves that they could bring online as 2022 unfolds.
There was another one from the audience as well, more of a current event. How would tankers be impacted if the Russians invade Ukraine?
Oh, yeah, no small question. So, Russia supplies, they export 5 million barrels a day. A lot of that is supplying Europe and is short haul tanker trades. So I think it would depend upon how extreme these, prolonged and extreme sanctions would be, the disruption of trade would be, because if Europe has to pull from other markets, then it gets pretty exciting for the tanker space, because then you're bringing cargoes either from the US, you're bringing them from West Africa, you're bringing them from a longer haul source, such as the Middle East, up into Europe to supply some of this disrupted trade. So, I think that, the Russia-Ukrainian standoff could result in disruption. Generally, disruption ends up being positive for tankers. However, we're not looking for that type of resolution in that situation.
Yeah.
That would be my reply. Jeff, I don't know if you want to jump in there.
Just totally agree. We see the market structurally not in decline to the first question, and that, in the short run this year, demand will increase not only to pre-pandemic levels, but beyond. And as you say, the U.S. surprisingly is now predicted to produce its highest level ever in 2023 and on the way there in 2022. And with all that happening, inventories down, demand up, Olympics about to be Omicron, beginning to decline in at least the places it started. Olympics will take place and mobility will pick up in China after that. We see that the market's going to improve without such extraordinary events as Ukraine. So I'm with you, Lois. We don't root for disruptive geopolitical events because it takes a toll, human toll, and other economic tolls. But to answer the question, if it did happen, it'd probably be positive for our market.
Yeah, thank you, Jeff.
I think as you've walked through the market, I think, and Jeff, I think you shared a historical reflection on the capital allocation. As we look into 2022, how do you think about capital allocation for INSW?
Yes, well, as I said, first of all, we've built a 2-year track record of appropriate capital allocation, and we've built a 5-year track record of capital allocation that has been enhanced in the last 2 years by our ability to return cash to shareholders. So we want to continue that track record. We think that now is probably not the time that we'll be allocating a lot of cash capital to vessel acquisitions apart from a tactical acquisition here or there. We've made our big move last year. So we've done, as you saw from the expanded balance sheet. So we think the priority this year will be normal deleveraging, which happens through amortization of our existing debt facility. So that will provide a nice healthy level of deleveraging without any special effort to allocate capital there. So likely the highest priority will remain to look at, with excess cash, and we will always be prudent, but when there's excess cash, we'll look at returning cash to shareholders. So we have a record in 2022, like we did in 2020 and 21, of having a decent amount of return to shareholders. That's, at least certainly can say, the most accretive thing that we can see out there right now.
And I think this may be close to the last one. More pointedly, when do you see rates improving significantly, or is there a driver specifically that we should be monitoring to, signify that the rates are going to come back and pop?
Tom, I love your supply demand and your market slides in the back of the deck. Why don't you go to slide 17 for us? So, I think this is one of the, this is more of a medium term outlook on talking about the market, but what you can really see here, and I think what this chart visually shows what we talk about all the time, is the increase in supply coming from the West. I was mentioning Brazil earlier, the US, and we shouldn't forget Canada. Canada continues to come online with their heavy barrels and push those down into the US, which then pushes more US crude out into the markets for export. And then you see in the Asian markets, a nearly 5 million barrel per day increase. In this snapshot, Tom, we're going from, we're taking that very big view from 2019 to 2026. But what I like about what you depicted here is that 2019 was a robust year that was pre-pandemic, and it doesn't reflect anemic numbers. It really reflects a healthy and proper market. So, when we look at the tanker market and we say, okay, what is going to be, the leading indicator and the drivers, we look at refinery margins and the robustness of those. We look at demand behind the scenes, which has been higher than what had been anticipated. IEA, EIA, OPEC had all expected for us in January to be in a big inventory building position because Q1 tends to be weaker, certainly, than Q4. And December, we understand that inventories drew over 2 million, perhaps close to 3 million barrels per day. January, we are also not in an inventory building situation at present. So, you're seeing a much tighter market than what had been anticipated. So on the tanker front, we tend to look at recycling, and we are seeing very strong recycling prices. You're seeing some of the prices in the subcontinent over $600 per ton. Certainly at International Seaways, we recycled some of our older Panamaxes in 2021. We did that in accordance with the Hong Kong Convention to make sure that all the hazardous materials were safely disposed of, the workers were safe in the dismantling of those vessels, and we did all of that in India. But the increase in recycling that we see, and in the second half of 2021, we saw more than in the first half. We would expect to continue to see the recycling post strong numbers on the tanker sector in the beginning half of 2022. So we like to see the recycling. We like to see strong refinery margins. We want to see strong demand of overall crude and product in the world. And we also want to see the supply. OPEC's going to have their next meeting here coming up here in less than 2 weeks. And we want to see them continue to bring back barrels to the market.
We've had a few come in as well. I think I'm going to start off with this next one, which says, we've seen the product rates have a bit of an uptick. Do you expect crude to catch up to that level as well?
Yes, thank you. So, on the crude front, it's been, the cargo counts in December and January out of the Middle East have been stronger, and we've seen more cargoes lifted than we had previously. China is one of the very important factors. We expected and we believe that they're holding back a little bit. They like to have their blue skies for the Olympics. That was one of the things we anticipated. And when we're looking at the big crude, we expect the Suezmaxes and the VLCCs, they have a very high correlation. We've also seen a higher cargo count on the Suezmax sector. And we've seen West Africa come back with some of the barrels that they had been missing earlier in 2021 when they were having production problems.
Next one comes to talk generally around the order book, yard availability for new vessel construction. And I think probably the secondary part of that question is your view on how technology, emissions, regulations will impact such new building decisions going forward.
That's a really simple question. Yeah. Well, you know, when you look at the new building yards, I never ever say, oh, you know, they can't build anymore because, you know, people said that in 2006 and 7, and then we know what happened. However, what I will say is that from that absolute peak of worldwide shipyard capacity over the last more than a decade, we have had significant reduction in worldwide shipping building capacity. And when you look at the shipyards, container market, everyone knows, has been, you know, through the moon, as has dry cargo, as has LNG been. So the very strong, you know, yards are very happy to have their books filled up with these expensive, high quality vessels that they need to build. And that leaves a little less space for tanker new buildings. And, you know, indeed, it is International Seaways' view that we would not be building a conventional engine today. We would look forward. We would love to collaborate with our oil company customers in the way that we have done with Shell, where we're building these 3 dual fuel vessels that will be delivering this time next year. And we think that their timing, that will be excellent timing. But we would not be ordering a conventional engine on spec today. And I think that most tanker owners share that view.
Hey, Tom, can we, Lois, with your permission, can we go to slide 21 and then 22 real quickly? That'll help visualize this. So if I may, on slide 21 here, you can see first for the crude on the left and then product, the order book in the light color, which is summarized as 8%, right? So for crude is just about equal, and 6% for product. So first of all, those are historically low numbers. Second of all, they match up exactly with the column that's 20 plus, a dark blue column. 20 plus for crude is 7% and 20 plus for product is 6%. So we know that we wouldn't operate a vessel over 20. They become much less utilized by the customers we talk to. So they're naturally recycling candidates. So we have the order book as it is, matched very well with the candidates to leave over these coming 3 years where you see the order book. And then to Lois's point on the yards being full, let's go to the next slide. Okay, the dark blue on the bottom is numbers of tankers that are ordered. So you can see that in general, 2020, 2021, and even 2022, which is a little bit up from 21, you know, still relatively lower than some of the heavier delivery years in tankers. But that's not the news. The good news, the really good news is that if you look at 23, it's exactly what Lois said. The yard order book, which is full, by the way, there are no more orders that you can put in a serious yard for a high quality tanker, at least in 23. You know, it's full to the brim and above with other types of vessels, container, LNG, et cetera. And look how small that order book is for tankers. So, and can't get bigger, as I said. So this sets up well for the recovery that's coming this year. And then, you know, we'll really have some legs to it because there's no way to over order for next year and even difficult to imagine for 24. So I think that sets up really positively for the future. And I just wanted to bring that stat out, Lois, to go with what you were saying.
Thank you. That's excellent.
I think I'm just going to do one last question. It's a little bit more specific, but I think for all of us, this is a pretty good one to get out. How will the IMO 2023 impact the tanker fleet in terms of slow steaming?
Yes, so, you know, the 2023 and EEXI, you know, the majority of the tankers in the world will be fitting power limiting switches, which, you know, depending upon the type of vessel and the year it was built, you know, will come into play in the forward going years. So, you know, vessels are going to have to be monitoring and reporting, and ultimately, you know, the world fleet won't have to slow down much in 2023, but as we move forward, indeed, you know, these power limiting, I would say, you know, on the tankers will come into play, and the world fleet will be affected and slowed down. You know, the world fleet is close to 10 years old. It's over 9 on average. And there's a big swath of vessels that will be affected by the requirement to slow down as we move into the middle of the decade. Okay, so Tom, if that's it on the questions, I would say thank you everyone for listening to International Seaways today. We are in a really dynamic and exciting space as 2022 starts out. We see that the tanker market is really on the precipice of a market recovery. Oil demand has come back, and you see that reflect.
Lois, we lost you for a sec.
In oil prices that we're coming to fruition in 20.
It's just a momentary loss, but
Okay.
maybe
Uh,
you can give the closing.
I'll be happy to close out. Sorry, we lost Lois for a second there, but what the recap is, as you can see from, we are clearly at the beginning of a exciting period for the tanker market as we experience our post-COVID bump, with all the conditions being in place for really robust pickup in rates, you know, during this year and going into next year, given the reasons that we talked about, the order book, et cetera. So it's really good to be talking to investors now. Nicholas, we really thank you for inviting us to this panel, and happy to be speaking to your audience. And we're always available for follow-up. So look forward to speaking to people as we go through this year.
Well, Lois, Jeff, and Tom, thank you very much for being with us. It was a very well-attended presentation. And just to note that this will also be available for replay for those who would like to come and access it later on. Again, thank you very much for being with us today.
Thank you. Thank you. Bye-bye.